ACA Small Business Boot Camp and Resource Collective for this Thursday, January 28th. We're excited to have you here. I'm Robert Theobald, the Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority. We want to first start by thanking all of our community partners. We could not do these boot camp sessions without their help, support, expertise, time, and effort. They are essential to the boot camp success, and we appreciate them very much. So the Small Business Boot Camp and Resource Collective is designed to help small businesses work through the COVID crisis and return stronger than ever. It is a statewide initiative involving the community partners from all four corners of the state. And the Boot Camp and Resource Collective is set up on our website with a lot of great information. The webinars, the registration for the webinars are on this page. You probably went there to register for this session, but also included is the link to the Resource Collective and the archive of all the previous sessions. Today's session 115, but we have well over 115 sessions when you include the special sessions we've done. And all those sessions are recorded and available in the archive that can be found on this website. You can go back and rewatch them or watch them for the first time. We include the slide decks that the presenters shared with us, so there's a lot of great information. As I mentioned, you can also find the Resource Collective on that page, and this is the link to it as well. The Resource Collective is a page set up with tools and resources brought by our community partners to help small businesses work through the COVID crisis. This is just an example of some of the resources that are available on that page. You've got insurance guides, you've got guidance for retail, guidance for barbershops and cosmetologists, restaurants, construction, manufacturing. There's a lot of great tools and resources to help all different industries. Go through a couple of quick updates. I just want to remind everybody that the Ppp Lender List is available. That is put out by the SBA District Office, lists the Arizona lenders that are doing PPP loans. Additionally, the Emerge AZ FAST grant is available for startups and tech companies. It's a great program there. And then the City of Glendale and Prestamo CDFI just joined together to provide the Pandemic Response Small Business Assistance Program for businesses in Glendale. So that's another new program providing some funding to help support the Glendale small businesses. Additionally, to stay informed of those grants and other grants, you can find them on our COVID-19 Arizona Business Resources under the Financial Resources section. But this website also has business guidance and updated information to help support businesses throughout the state during this period. Additionally, the ACA has a number of different programs to help small businesses throughout the state. Our small business services can help navigate with the SBA, working with the Small Business Development Centers or SBDCs, working with SCORE, local banking contacts, etc. There's a number of great no-cost business counseling programs we can help guide you to as well. Our workforce division can help your small business as you look to hire employees or train and upskill your employees. They have a number of programs to help with that. And then the Manufacturing Extension Partnership works with manufacturers throughout the state, small to medium-sized manufacturers looking to grow, expand, fine-tune their processes and procedures. They have a great nationally recognized program, and we highly recommend you reach out to them if you're a manufacturer. Additionally, this time a lot of people are looking to start side businesses or start full-time small businesses, and our small business checklist is designed to help entrepreneurs with identify the licensing, registrations, compliance opportunities related to opening a small business, both at the local, state, and federal level. A lot of great information on this checklist, very in-depth, and can help guide you as you work to open your small business. Additionally, the state's COVID-19 information and resource page has a lot of great information, not just for businesses, but for all facets related to COVID-19. You can find that at arizonatogether.org. So a quick look at next week's sessions. We have 2 great sessions by our partners at the Small Business Development Centers. Tuesday's session will be brought to us by the Yavapai College Small Business Development Centers on 10 steps to starting a business in Arizona. And then on Thursday, the Small Business Development Center from Maricopa County is going to be with us talking about cash flow management, knowing your cash position during COVID-19. We are also looking forward to that session. With that, we will turn the time over to our speakers for today. We have Tom Fulcher, founder of the Idea Gardener, and Carrie Ann Todd with BeachFleischman. We are going to touch on PPP again today, and they are 2 of our experts that have been very helpful with us throughout the pandemic. So we're grateful to have them back again. So Carrie Ann and Tom, we'll turn it over to you.
All right, thank you, Robert, for that introduction. Thanks for having Tom and I today. Let me get my slides rolling here.
While Carrie Ann's getting her slides set up, if you have questions, please place them in the Q&A box at the bottom of your screen. Also, before you ask the question, I recommend listening to the presentation because many of your questions may get answered throughout, but we will have some time at the end for some PPP questions.
All right. Okay, so quick little disclaimer here. You know, this program is changing. It's changed 50 times since it was first authorized with the CARES Act back in March. So everything you learn today is just current as of today. So if you're coming back and looking at this in 2 months and watching this in the archives, just keep that in mind that there might have probably was something that changed. So today's January 28th. This is also really high level. So I have a ton of slides. There's 83 slides in this presentation. You know, Tom's going to speak about the EIDL programs and the Shuttered venue grants. I'm going to touch on PPP and then the employee retention credit. We're going to try to stay really high level just because of the time, so that we can leave time for questions at the end. So if you have detailed questions, you probably need to consult with a CPA or your accountant or whoever you go to your business advisor for more details. Okay, so PPP loan forgiveness. There's a lot of math, and it's not hard math, it's just a lot of math and a lot of things you have to get through. And I would say the exact same thing about the employee retention credit that we're going to talk about at the end. So if you just kind of accept the fact that it's a lot of calculations and then just work your way through the program step by step. I know you can do it. I know you can get to forgiveness, but it may be something that is not, you know, in your wheelhouse, something that you're comfortable with. So just kind of walk it through and you'll get there. Okay, so the Consolidated Appropriations Act, that's the new bill that was signed right after Christmas in the end of 2020. Changed some of the loan forgiveness rules. Okay, on January 19th, the SBA released revised loan forgiveness applications that incorporate the changes. Those forms can be used by anyone to file for forgiveness, whether you are filing for forgiveness on a round 1 loan or a round 2 loan. Those are the forms that they want you to use going forward. So there's a link there for you to go out and get the most recent forms. Okay, in my slides, like I said, there's a lot of them and we're not going to cover all of them because we literally just can't. But I try to put a star, this cute little red star, on any slide where there's information that's new and different that came out of that legislation. Okay, so this is one of the new and different things. Form 3508S, which is the form that originally was only for loans up to $50,000, can now be used for loans up to $150,000. So while in some ways that's a good thing because it's only 1 page, they didn't change the rules for all the loans between $50,000 and $150,000. So all the nice breaks from the rules that were given to the loans under 50 do not apply to the loans between 50 and 150, even though they're eligible to use the 3508S, which is a 1-pager. So it's important when you read the instructions, if your loan is less than 150,000, you need to read the instructions to that 3508S and make sure you understand the rules that still apply to you. The main one being the FTE reduction rules and the wage rate reduction rules. And we're going to talk about those briefly. Those rules haven't changed. So if you're completing the 3508S because you're less than 150,000, if you would have qualified for the 3508EZ, and if you look at the 3508EZ instructions, you'll see that if you did not reduce wages and you were unable to operate, or you didn't reduce FTEs, then you were kind of exempt from some stuff. Those rules of the 3508EZ kind of apply to the people between 50 and 150. And you can see the confusion here, right? I almost wish they would have just created a new form, called it something else, because it's like now they have 3508S and there's two separate rules you have to follow, under 50 and then 50 to 150. So if you don't meet any of those exemptions and you're in this range, then if you did reduce FTEs, and you don't qualify for the unable to operate exception, the costs that you submit eligible forgiveness are going to be reduced. And we'll talk about that more detail here shortly. But all of these rules are outlined in the instructions to form 3508. So if you really want to know all the rules, what they are, they're on 3508. Okay, 3508EZ can give you some of the exemptions, and 3508S is the one pager that you would file. So it's almost like you have to read all of them to really understand how you're supposed to fill out the 3508S. And from that perspective, if I feel like they made it more confusing, even though it's technically a one-page form. So just be aware of that. So the basic concept of FTEs, if you recall, the purpose of the PPP program was that the government was giving you money to make sure you were able to make payroll and you didn't have to lay people off. Okay. And the concept was, don't lay people off. And if you lay people off, there's going to be a slight penalty in the forgiveness formula. Okay. Now, a lot of companies can get over that penalty mathematically because you can use up to 24 weeks of wages, but it's just something to keep in mind that you have to maintain your same level of employees in order to not be hurt in the calculations. So anytime we're talking about FTEs, it's based on a 40-hour week. So my examples here, Joe's 30 out of 40, he's a 0.75. Mary works 20 hours a week, she's a 0.5. Bob works 55 hours a week, he's a 1.0. You can't be more than a 1.0. So anytime in those forms, when you see them talking about FTEs, this is what they're talking about for each and all employee. What are they equivalent to in a number? Now, they did give you a simplified method if you didn't want to go through and look at what every single person works to figure out their FTE. You can basically lump your employees into two categories. Anyone who works 40 hours or more is a 1.0, and anybody who works less than 40 is a 0.5. And this formula is really helpful for the hospitality industry to easily segregate your employees and not try to figure out their average hours worked, because as you know, that changes all the time. So consider the simplified method. So owners get excluded from all the FTE computations. And that's kind of all I'm really going to say about FTEs. I just wanted you to understand when you're looking at the rules, what they're talking about when they're talking about FTEs, okay? So let's talk a little more about wage rates. And all these slides will be in the presentation that Lisa and Faith will distribute after the presentation. So you're still gonna have all that information. I just wanna make sure we get through the highlights today so that, like I said, we're gonna stay high level. So the other rule with the program is that they don't want you to reduce anyone's wage rate, okay? And when we talk about wage rate, we're talking about base salary and base hourly rate, okay? And so again, because the government is giving you money through the PPP loan to fund your payroll, one of their requirements is do not cut people's wages, okay? Don't cut their hourly rate. And if you do, excuse me, if you cut it more than 25%, there is a reduction to be applied to your costs eligible for forgiveness, okay? So there's sort of a penalty. Again, with 24 weeks of wages, sometimes you can overcome that penalty. But if you do reduce wage rates more than 25%, regardless of the size of your loan, you have to file Form 3508. Okay. Under no circumstance can you file the 3508EZ or the 3508S. So that's something to consider when if you're going into PPP2 and looking at what you're going to do forward with your the compensation that you pay to your employees, you need to keep that in mind. So here's just a basic example. For Joe, he's full-time, he makes $1,000 a week, but you cut his salary to $650. Okay, he's still full-time, but he just makes less. So in this case, the program allows you to reduce Joe's salary to $750 a week, but you reduced it to $650 a week. So it's $100 penalty per week multiplied by the number of weeks in your covered period. I just used 8 as an example here. So if you're going to claim and report 8 weeks of costs, the penalty just for Joe would be $800. And as you can see, this is applied on the individual employee basis, which it gets into a lot of math. Okay. So kind of the moral of the story on wage rates is just don't reduce the wages more than 25% and you don't have to deal with any of this. Here's a quick example for Mary. She's hourly. So when someone's hourly, you're just looking at their rate. Okay, you're not looking at their hours because hours can go up and down. You're just looking at their rate. So in this case, Mary was making $20 an hour. So under the program, you're allowed to reduce her to 15 without penalty. But in this case, we reduced her to 13. So that's a $2 penalty per hour per week that you report just for Mary. Okay, so hopefully that makes sense. In the revised application instructions, they are saying that the base period for comparing rates would be the most recent calendar quarter in the covered period. So if you haven't yet applied for forgiveness on round 1, your base quarter is going to be Q1 of 2020. If we're talking about a PPP2 loan, a second draw or an initial first draw for PPP2, and you're going to get the loan sometime in the next 3 to 4 weeks, your base calendar quarter is going to be fourth quarter of 2020. Okay. If you happen to get a loan in April of 2021, well, you can't actually because the program ends, right? March 31st. So for everyone in this second round of PPP2, your base quarter is going to be the fourth quarter of 2020 when you're doing this wage rate comparison. Okay. All right. That's all we're going to talk about. Those two quote penalties. They're not really, like I said, you can kind of overcome them mathematically if you have enough costs. So don't get nervous about that. But do keep those things in mind as you're going into your next covered period on PPP2, that you need to be cognizant of keeping your employees, not doing layoffs because the government's funding your payroll. So they want you to keep everybody on the payroll. And if you're going to reduce wage rates, you need to keep those reductions below 25%. Okay. Also on your loan forgiveness application, you report all your costs, right? They're called covered costs. And that's a technical term that you'll see on all the applications and the application instructions. And there are 8 categories of costs that you can report. Okay. The 4 original categories are payroll costs, rent, interest, and utilities. I have slides on here on what those are, but we're not going to spend a lot of time on them. If you go back to some of the presentations on the boot camp that I did in the summer, they'll go through the forgiveness details and these costs in detail, or you can read the instructions. I mean, they're pretty good now about what qualifies and what doesn't. But we're going to talk about the costs that were added by the CAA, okay, the Consolidated Appropriations Act. Covered operations expenditures, covered property damages, covered supplier, and covered worker protection expenditures. Okay, you may or may not need these, but they are categories that have been added. Okay, so here's, like I said, there are slides on payroll costs. I will point out one thing. Okay, 2 things actually. So when you're looking forward, even if you're looking back, you cannot claim wages for multiple programs. Okay, so there's the PPP. There's the Families First Coronavirus Response Act, the FFCRA, which had a payroll tax credit for qualified sick leave and qualified family leave. And then now there's the employee retention credit. You cannot count wages for multiple programs. So if you count wages for FFCRA, those wages are locked into FFCRA. They cannot be counted on PPP or ERC. Okay, if you count wages for ERC, those are locked out. Can't use them on PPP or FFC, right? You see where this is going here, right? I'd have this as double dip, but really now that we have the ERC, it's a triple dip. You have to allocate your people's wages between the programs. You cannot count them twice. Okay, so rent, utilities, interest, all those slides are here. Let's talk about covered operations expenditures. Now, I have given you the text exactly from the instructions. To be honest with you, in the actual Consolidated Appropriations Act, which is very long and very detailed, there's a lot more information. This is kind of the summary of what that means. So if you're not really sure, honestly, you need to find somehow to dig into the regulations if you really need additional costs. I think in most cases, you're going to be able to get forgiveness with just payroll and maybe your rent, maybe your utilities. You may not need to dig into this, but maybe for restaurants who are now getting 3.5 times their average payroll, they might need to dig a little deeper. So anyway, so covered operation expenditures here is basically for software, cloud software. I mean, you could get really broad here. If you read this, tracking of payroll expenses, okay, does that mean my ADP or my paychecks, bills? Human resources, if you outsource that. Sales and billing functions, okay, does that mean my QuickBooks fees if I pay that during the covered period? Those are things you need to look at. The next category is covered property damage. So this is very specific, okay? So it's costs related to property damage and vandalism or looting due to public disturbances that occurred in 2020 that were not covered by your insurance or other compensation, okay? So that's the definition. But be clear, you have to be making these property damage fixes during your covered period, okay? So PPP 1, that's probably easy, right? Because your covered period was over the summer. That may have been the time you were fixing the damage. If you're looking forward to PPP 2, it would only be residual damage that you're fixing and paying for during your 2021 covered period related to vandalism that happened in 2020. So make that distinction. It's not saying on your PPP2 loan, a second draw, you can count all this stuff from 2020. No, that's not true. It's only what you pay in 2021 that's related to 2020 damage. And I know in Arizona, that wasn't a huge concern. It was a bigger issue in other places in the US. Okay, covered supplier costs. So this one is very confusing. You can see it's a very long definition. So kind of the way I look at it is think of it as you can include the cost of your inventory as long as you had a PO in place before your covered period. So what they're really saying is if you, for whatever bills you had in your AP, accounts payable, before your covered period, if they meet this category requirement and you pay them during your covered period, the eligible costs. So like if you're a restaurant and we're talking about food, there's a special rule for food. So it's potentially things that are inside your cost of goods sold, but you really need to read this definition and make sure you understand that. And it's twice as long in the actual legislation. Okay, covered worker protection expenditures. This one's going to make way more sense to everyone. It's operating or capital expenditures that facilitate the adoption of the business activities of an entity to comply with the requirements, blah, blah, blah. Okay, it's PPE, sneeze guards. I know that's not what they're called, but you know, the plexiglass that you put up to keep everyone safe. All of that stuff that you had, the physical alterations you had to make to your business, costs for that. Again, if they're paid for during the covered period, are includable. And then the PPE, right? The masks, the hand sanitizer, all that stuff. This is the category that makes sense to everyone. Okay, and then the last, it keeps going on and on, but everyone understands this one, even though the definition is the longest. So again, the important distinction here is that all eligible payroll and non-payroll costs have to be paid or incurred during the covered period. So when your covered period starts the day you get funded, and it ends anytime between 8 and 24 weeks after that day. It's your choice. Okay. All right, so I'm going to kind of skip through the rest of these slides. They go into a little bit more detail, kind of the restrictions and the rules and the formulas and all that stuff. But I want to hop over to Tom here and talk about the EIDL programs for a little bit, because I know those are both kind of confusing, and I want to make sure Tom can explain all those for you. All right, take it away, Tom.
Sorry about that, it was muted. We're going to talk about multiple aspects of EIDL and a couple other programs. We'll start by looking at EIDL advances. So they're part of the CARES Act program. And prior to the December 27th, 2020, when President Trump signed the new CAA, the company with PPP loan had to reduce the amount of forgiveness by their EIDL advance. So you may recall the EIDL advance was $1,000 per employee up to a $10,000 max. The recent rules have reversed that. So if in the past you had a 70,000 PPP and a 5,000 EIDL advance, your maximum forgiveness was going to be 65,000. That is no longer the case. So any business that had the forgiveness reduced will be made whole in 2021. And that's a bit of a, what does that mean exactly? And, we're waiting to see exactly how that's going to work. Sorry, that's not cooperating fully. So the advances, as we said, don't have to be repaid. There we go. And they're not taxable. And in terms of anything it was used for, again, those are still deductible. So if you had an EIDL advance and you haven't applied for forgiveness yet, it's kind of a don't worry about it. The lender should make that whole. If you've applied for forgiveness, received forgiveness, but not started paying on that, again, you should be okay. Your lender will work with the SBA, that'll be made whole. And I've worked with some companies that have applied for forgiveness, got it reduced, and are making payments. Again, that money related specifically to the EIDL advance and interest related thereto will be coming back to you, and you'll be made whole, as the slide said. And if you have a loan beyond the EIDL advance, that still remains a loan. You still have to make payments on those. We're not sure the exact process on this yet, but we know that the SBA is going to be working with lenders to get this taken care of. So my main advice on that is stay in touch with your lender and stay on top of that from that perspective. So now we're going to touch base on EIDL loans, and they are separate from the EIDL advances. So any company that applied for and received an EIDL loan in 2020 received up to $150,000. There was a very, very small window before that cap, but some companies may have received additional. And these terms are fixed. This is a loan. It's not forgivable. It will not be forgivable. 3.75% interest if you're a nonprofit, 2.75%, 12-month, full year delay in payment, and a 30-year amortization without any collateral requirements. The EIDL loan is, as I said, it's a real loan. You have to repay it, no forgiveness. All right. So we want to just keep stressing that, because I know I get asked that a lot. I think a lot of people were hopeful that with the new bill, maybe that would change, but it did not. The EIDL itself was extended through 12/31 of 21, or while supplies last. Now, I just want to stress, this was an extension. This is not a new program. So while nothing has been written to date, saying XYZ relative to second EIDLs, do not expect to be able to go back and get another EIDL. This is simply a program extension timeline. So there's no real rules that said, oh, you can now get a second EIDL. So I don't expect that. I will say the EIDL advance was not extended. So if you've not applied for an EIDL and you go apply for an EIDL now, you will not see the checkbox that says, do you want to be considered for an advance? That program has sunset. So, well, let's talk about the new targeted EIDL advances and grants. And I cannot agree with Carrie Ann more. We needed a little more creativity in what we name things. Again, like her, I wish this was named something other than target EIDL advance. Sometimes in the law, it's called EIDL grants, and it's caused a lot of confusion. But there are two forms of this targeted EIDL advance. The priority one group, you received an EIDL loan, you're located in a low-income community, and you've experienced at least a 30% reduction in gross receipts for an 8-week period, March 2nd of 2020 through the end of the year. All right. And part of this is you did not already receive a $10,000 EIDL advance. So that's priority group 1. So they can receive, if you're in this group, you can receive a grant that when combined with any advance you did receive will total $10,000. So if you received your loan, but no advance, you'll get $10,000. If you received your loan and say a $3,000 advance, you'll get $7,000. If you received your loan and a $10,000 advance, there's no additional money for you. But what if you're not in that priority 1 group? There is a priority 2 group. These are people that received an EIDL loan prior to 12/27 of 20, these are companies, but did not receive an advance at all. In priority 2 group, they will be eligible for $1,000 per employee up to $10,000 max. So it looks more like the traditional or original EIDL advance. But again, they're priority 2. So, and I say it's unclear on new EIDLs. We don't expect new EIDLs to be able to get the grants, but that hasn't been issued yet. And you'll see the words Sba Outreach. And what does that mean? Well, what the Sba has told us is that they're going to run their reports on who in this time period last year received an EIDL loan and received less than $10,000 advance. And then they're going to compare, for the first priority group, they compare that to the 30% reduction in gross receipts. I'm sorry, to the located in low-income community, they won't know the gross receipts. And then they're going to send out, their SBA is going to make contact with you. And if you're in priority 1 or priority 2, give you the opportunity to apply. I'm a little concerned with this process because if they're comparing you to your census data, I don't know if that will show them, your business is in a low-income community if your mailing address is not. So I'm not quite sure how this will work. They haven't clarified timeline. But at this point, the only message is nothing you need to do at the moment other than know your own history. There's nothing you need to do. The SBA will do an outreach and hopefully they'll come out with more information soon on this program. So SBA Debt Relief, touch base on that one. If you have an SBA 7A 504 or microloan, this is not for regular lender loans. If you've got a loan with the bank that's not SBA, this does not apply to you. If you had that loan last year and it was approved by the SBA prior to 9/27 of 20, you should have already received 6 months of debt relief. And what that means is the SBA paid principal and interest for you on your behalf directly to the lender, and you didn't have to pay it. And that was, they use the phrase automatic. If you are in that situation, you can receive an additional 3 months beginning in February of debt relief. If you are in a certain group of NAICS codes, and Robert, if you don't have those, I'm happy to send them to you and you can post them. If you're in a certain group of NAICS codes, beyond that 3 months, you can receive 5 more months. So a total of 8 months of additional debt relief. And again, they're saying it'll happen automatically. Here's the bad news. If your loan was approved by the SBA from 9/28 of 20 to 1/31 of 21, currently under the current rules, you do not qualify for anything. Now, will it come back to 6 or 9 months? I don't know. I'm very hopeful it will, because if you've got your loan going forward from February 1st of 21 forward, you will qualify for 6 months. So this donut hole doesn't make a lot of sense to me, that just because you got a loan from 9/28 to 1/31, everyone before you get something and everyone after you get something and you don't, doesn't make a lot of sense. So I'm hopeful, while there's been some procedural notifications from the SBA, they haven't issued a lot of FAQs on this and guidance. So I'm hopeful that guidance will take care of that. Again, this is automatic is the phrase they use, but don't trust to automatic. Have a good relationship and good communications with your lender. Finally, just to touch on shuttered venue operator grants. These are specifically for NAICS 71, arts and entertainment and recreation. So just like in PPP, there is additional funds for NAICS 72, food and accommodations. This also targets a specific group. You can see that list, but it's anyone in that performing arts space, museums, all kinds of people meet the eligibility requirements. Little change, they had to be in operations February 29th as opposed to February 15th. And they can have received a loan, a PPP before 12/27, but they cannot get a PPP after 12/27 and qualify for this program. So this program requires you're in operation by January 1st of 19, and you can get 45% of gross earned revenue or $10 million, whichever is less. Now, again, on this program, we're waiting for additional guidance. For example, gross earned revenue, what does that mean exactly? If you're a nonprofit, you may have contributed and earned revenue. So it only counts potentially the earned portion of that. If you began operation after January 19th, you also qualify, and there's just a different calculation. So as you can see, this will allow these groups in this NAICS code a greater amount of money. They do have priorities. So for those that received experienced a 90% reduction or more in gross earned revenues, and as you know, a lot of shuttered venues, be they movie theaters or performing arts or concert halls, even some museums did. They are the first 14 days they can apply. The next group is those that received 70 plus can apply in the next 14 days. Then 25% reduction are next after that first 28 days. And then there's also some supplemental funding. There's no application yet. There's no additional guidance on this yet. There is allowable use of funds and prohibited use funds that are out there. And there are many open questions around this. It's a very, very complicated piece of regulatory. And, I just mentioned one, earned versus contributed revenue. So it's a great program. We're excited about it. And the good news, if you're not in this, is because these shuttered venues will be receiving this, they will not be taking up part of the PPP funds that are available to everybody else. So I think we are done with that. And I will give this back to Carrie Ann.
Get myself back online here. Okay, I think I'm back in controlling, and we're going to talk about, we're kind of switching gears here, right? So, because the PPP and the EIDL, those are all they're tied to payroll, but they're not payroll tax credits. So, make sure you understand we're switching over to the employee retention credit, which is a payroll tax credit. Okay. So the Consolidated Appropriations Act, like I mentioned before, did two things. It removed the prohibition against companies who receive a PPP loan from taking the ERC. What does that mean? When the CARES Act first came out, it said, here's a PPP loan, here's the ERC. You can do one or the other, okay? Anyone who was eligible for the PPP went for that. Anyone who was not or couldn't get in or didn't get their loan did the ERC, okay? In December, they said, oh, wait, do over, all the way back to the beginning. Now you can do both programs. And then they also extended the ERC through June 30th of 2021. And then they modified the rules for 2021, okay? So we're gonna talk through those pretty quickly here so that we can leave plenty of room for questions. How are we doing on the questions? Do we have a lot out there? For some reason, I can't see them right now.
I've got one. I'm typing an answer for that one right now.
Okay, all right, so we're good. So the employee retention credit is computed using eligible wages and allocable healthcare costs. Okay, eligible wages are generally gross wages paid during the relevant period. Allocable healthcare costs are costs for insurance that are related to the relevant period. So they could be paid earlier or later, right? So think about wages, they're paid as they're earned, right? But your healthcare cost, you might pay your health insurance bill. If you pay it early before the due date, maybe the payment won't fall within the relevant period, but the coverage is for the relevant period. So the eligible wages paid is all about paid. Allocable healthcare costs is all about coverage. So those are kind of two different distinctions when you're looking at costs. The credit is available from March 12th to December 31st of 2020, as well as January 1st to June 30th of 2021. The eligibility and the computations are different, okay? And we're gonna address each year individually. So we're talking about 2020 first, okay? So everybody get in the mindset of 2020. So there's two different ways to be eligible. Okay, you had operations that were fully or partially suspended during any calendar quarter in 2020 due to government COVID-related orders. The credit only applies to wages paid during the portion of the quarter that the business is suspended, not the entire quarter. Okay, so if you were retail, whatever you were, and you were only affected for 8 weeks, it's only that 8-week period. If you're a restaurant, we're looking at the whole time, right? You were shut down from whenever they shut you down until probably now, because nobody, I don't think in Arizona, is back up to 100% capacity. So restaurants, any retail, anything like that is still kind of affected by COVID restrictions is going to easily meet the first bullet. Okay. And if you didn't meet that, let's say you were an essential business, or you just weren't directly affected by a COVID order shutdown, you might meet bullet point 2, and it is an or, so notice that there. Okay. If your business experienced a significant decline in gross receipts during any quarter in 2020, and the significant decline is considered to be 50% or more, and we're comparing ourselves to 2019. So let's pop over to an example of the gross receipts test. Okay, the COVID shutdown, I think, is pretty explanatory. We've all kind of understand that now. So you're going to use the same accounting method that you use for internal accounting, because of course you're going to have to look at your revenues quarterly if you're able to. Okay, if you don't have detailed enough accounting records that you can look at quarterly, that's okay. If you look at annual and you meet the 50% test, you can also qualify. Okay, so don't think that, oh man, I don't keep my records that close, I'm out. You can look at your annual records. So here's an example. You can see in example 1 that in the first business, in the first quarter, their revenues were more in 2020 than they were in 19. In the second quarter, they were down, and their 2020 receipts are equal to 42% of their Q2 2019 receipts. Remember, we're talking lots of math here. Okay, so because they're below 50%, they're eligible for Q2. Now, you stay eligible until you get back over 80%. Okay, so the relationships here is we're dividing 2020 by 2019. So you can see for Q3, we're right at 50%, and for Q4, we're at 75%. So we're doing better, right? We're still eligible for the ERC because we haven't gotten back to the 80% level. If you look over here at the example 2, we're eligible here in the second quarter, we're eligible here in the third quarter, but we're not eligible for the fourth quarter, okay? Because we're the first quarter where you get past 80. Okay, so those are some examples on how that works. So wages costs are eligible for the credit is dependent on how many employees you had. So it's a better credit if you have less than 100 full-time employees in 2019. And what's really exciting, and you're gonna love this, is the math to figure out a full-time employee is totally different than the math you use on the PPP. Okay, so the math is totally different. Under this program, a full-time employee is someone who works 30 hours or more per week, and you only count those people. So if someone works 20 hours a week, they don't even count. You only count the people that work over 30 hours a week. That's how you get to figure out whether or not you have 100 or more than 100. And you see the math here. I kind of go through that. There's a lot more information. The IRS FAQs on the ERC, they have not been updated for this new program, the new changes from the CAA, and the IRS website tells you that in big bold letters. But the original ERC FAQ has 84 questions, and they're kind of segregated by category. So if there's a question you have, odds are the IRS has answered it in these FAQs. So they're actually a really good resource. I probably go there 6 times a day with different questions. So definitely use that. So if you have 100 or less full-time employees in 2019, okay, all of the wages, including healthcare costs, paid during the affected period or quarter and after March 12th, 2020, minus any FFCRA wages. Okay, those are the wages that are eligible. Employers with more than 100 employees, you're not out, but it's limited. you can only take the credit on wages and healthcare costs paid to or for employees who were not working. And by that, we mean literally paid to stay home and not do anything, okay? And there were some businesses that had that scenario in the early second quarter, right, of 2020. So you might not be out completely. So once you figure out what category are you in, 100 or less, 100 or more, I should say 100 or less or over 100, and you figure out which wages those are, then you compute the credit. The credit is 50% of the first 10,000 of wages and allocable healthcare costs. Okay, so the maximum credit is $5,000 per employee for 2020. Okay, there's 4 restrictions, and we're going to pop through these pretty quickly, but go back and read these slides so you understand the restrictions. Restriction number 1, you can't include wages that you're going to use for FFCRA or the work opportunity credit. Okay, and then this one is key here. Wages, I don't know if I can highlight here. I don't think I can, but wages paid to relatives or family members generally do not qualify. So if you go to that FAQ, it talks about which relatives are out, but it's basically like wives, brothers, sisters, and kids. And then there's some other ones that apply. So if you have a lot of family members in your business, you need to make sure you understand that list, because you can take credit for the owner, but you can't take credit for all the relatives. All right, restriction number 2. Oh, so sorry for that little errant circle here. Any wages used in the computation of ERC are not eligible costs for PPP. And I mentioned that before in Ppp forgiveness. If you have already gotten forgiveness on your round 1 loan, but you find out that you're eligible for the ERC, there's no rules yet on what you can do, okay? Right now, you're only able to look at the wages outside of your covered period that you did not report on your PPP application. Those would only be the only potential wages that are eligible. We're waiting for some guidance from the IRS and SBA that basically say to give you a do-over and to go back and figure out, okay, how can I maximize the ERC and maximize my PPP loan forgiveness? Okay, but we don't have that yet. So if you've already gotten forgiveness, don't hurry and start calculating. We kind of need to wait to see if they're going to fix that. Restriction number 3, there's aggregation rules on related party entities. So if you have multiple businesses or you have vertical ownership, if your structure is complex, you need to read about these aggregation rules, okay? Because it affects how you calculate everything and also how you calculate your decline in gross receipts. Oh, I thought there were 4. I thought I had a 4th restriction. Anyway, maybe I skipped over that. Nope. Okay, so you claim the credit on your quarterly 941. There is a form 7200 where you can request an advance credit. There, if you click on this link, you can get to the IRS website on how to claim the credits, and it'll walk you through that. Okay, there's an article on our website that kind of walks through it in more detail. And again, the IRS has this super extensive FAQ on the employee retention credit that's very valuable. So that's the basics of 2020 credit. Okay, now let's say you look and you're like, oh, I missed the boat on that. I don't qualify. I didn't have a 50% decline in receipts. I have over 100 employees. That's not worth it to me to go back and figure all that out. Okay, all is not lost. You might be able to take the credit for 2021. So it works pretty similar. Well, it works pretty much exactly the same way for 2021, but the metrics are different, meaning the percentages, okay? So once again, to be eligible, if you had a full or partial shutdown, okay, that's still there, or you had a decline in gross receipts. But now we're looking at only a 20% decline. And again, we're referencing 2019 as our base. So if you're going to look at the first quarter of 2021, you're going to reference your gross receipts in the first quarter of 2019. Okay, so make sure you understand that. All the base references for the most part are 2019. Okay, so once you do that, let's see, these are all the same slides as before. So here's our example here. When you compare 2021 gross receipts to 2019, first quarter is only 70% of 2019, so that's eligible. Second quarter is only 75%, so that's eligible, right? Because the bar is 80. there is this funny little a look back rule, which says if you don't pass it for the first quarter, you can do a look back to the fourth quarter. And so here's how that would work. You would look at your Q4 2020 gross receipts and your Q4 2019 gross receipts. And if that relationship is below 80, then you're eligible for Q1 of 2021. Okay. And then you would have to assess Q2 independently, I believe. Okay, so that's a funny little look back rule. Okay, other than that, everything, all the slides from here out are pretty much the same, and anything that changes I've highlighted in yellow. Okay, so remember on the 2020 credit, the employers with 100 or less got the bigger benefit. Well, now it's 500. Okay, that's a huge difference. That brings in a lot of companies. So if you have 500 or fewer full-time employees in 2019, again, we're looking at 2019 again. Okay, so keep that in mind. All this is back to 2019, which gets confusing. You get to lump in for everybody. Okay, if you have over 500 employees, you can only take the credit on wages and costs for people you paid to stay home and do nothing. Okay, so that's a big distinction. I don't know that anybody in 2021 is paying people to stay home and do nothing. We may be past that. Okay, what's the credit? It's 70% of the first 10,000 in wages, and you compute each quarter independently. So if you qualify for Q1 and you paid someone $10,000, and you qualify for Q2 and you paid someone $10,000, you're going to get $14,000 for that employee. All right, so it's a much more lucrative credit, and it's easier to get, as you can see by the percentages. All the restrictions are still the same, okay? The way you claim it is still the same. The key here I would advise going forward is figuring out how you're gonna get there, right? Because it's January 28th. You don't know what your first quarter gross receipts are gonna be. So in the first month of April, or first week of April, sorry, you're gonna have to sit down and look at your gross receipts for the first quarter. Okay, do I meet the test? If I do meet the test, should I take the ERC, or do I need to save these wages if I got a PPP-2 loan? Okay, so those of you who are going to get a PPP loan in this second round, if you're going to get funded in the next week or two, you see there's some overlap. So, look at the first quarter, figure out where you get the most bang for your buck, and you're kind of going to have to project out your payroll and try to figure that out. If you need the wages for PPP, which is a dollar for dollar benefit, right? For every dollar of wage you put on that PPP application, you get $1 of forgiveness. If you use that $1 of wages for the ERC program, you're going to get 70 cents. Now, if you work the math right, you can probably take at least all of the first quarter ERC and maybe have to use your second quarter wages for PPP. But there's a way to work it to where you can take advantage of both. But just remember, you can't double dip or triple dip because the FFCRA is still in play too. So that's all I had on my slides here. So do we have any questions? I think I have to stop my share in order to be able to see questions.
Yeah,
Okay.
there's two good questions, a couple good questions in there. So.
Okay, if a business was established during the pandemic, will the business be qualified to apply for EIDL or PPP? Tom, do you know the answer on EIDL?
EIDL, it had to be in operations January 31st of 2020. So I would suspect that the answer is no for this particular business if they did not start and get in operations until June of 2020.
Okay. And I believe for the PPP loan, you had to still be in business by February 15th of 2020.
Correct.
So for this business, I would recommend you try to go after the employee retention credit, because I don't believe you're going to qualify for either one of those programs. Okay. Round one was use 100% for payroll. The funds ran out in 4 weeks. Would we submit documents for the full 24 weeks or until the funds ran out? Okay. So one of the other changes that came with the CAA that I didn't really highlight on the slides is you can pick your covered period. Okay. So before the program was 8 or 24, right? Now, if you haven't applied for forgiveness yet, Elizabeth, when you go to apply for forgiveness, you can pick your covered period. And that really helps if you're trying to balance the ERC and the PPP, right? So you might say, okay, well, I'm going to include only these 12 weeks of wages if that gets you to full forgiveness, and add in some rent. Okay. And that leaves you with more wages to use the ERC on if you qualify for that.
Right.
So when you do your forgiveness application now, it asks you to define your covered period.
And Carrie Ann, she's mentioning in here the idle advance of 10,000, which, as we said, no longer reduces PPP. My concern is, she says the idle advance was also used for payroll. So this is a tricky situation. You can't claim the PPP forgiveness on that 10,000 if it was not paid with PPP. So you got to be very careful with that. And without more details, it's hard to really answer it. But yeah, you've set your own 8 up to 24 weeks forgiveness period, covered period.
Okay, and then I think we answered that last one about if you started a business in June 2020.
Yes, we did. And also for Elizabeth, with 14 weeks, if at 14 weeks, that's the end of your covered period, that's also when your 10 months starts to apply for forgiveness. Your covered period.
Right. Okay.
Excellent.
Okay, so we've answered all the questions. No, there's one more. I received a PPP in 2020. It was forgiven. I sold the business. Am I eligible for PPP 2? Only if you have a new business.
And only
Right.
if that new business got PPP 1.
Well, there's still, so if you have a new business that did not get a first round, you can get money out of PPP 2 under the first round rules.
First draw rules, right?
Yeah, under the first draw rules. So you cannot get a PPP 2 on a business that you do not own anymore. The new owner of the business that you sold was potentially eligible for a second draw on that business, if that makes sense.
Yeah, and that question's come up a lot, and it may hinge on if it was an asset sale or equity sale.
Okay. PPP 2 loan application requires that you spent all of PPP 1. We did not spend the entire funds, but we did spend it on covered expenses. The answer to that is yes. So there's no requirement that you spent all the money during the covered period. The requirement is that you have spent it all on eligible expenses before you file your application for a second draw. So if you want to apply tomorrow, as long as you spent all the money by today, or yesterday, you're in good shape. Okay,
All
look at
right.
that, 10:59 or 9:59. I think we're doing good today, Robert.
Right on time. Perfect timing. Great. So thank you, Carrie Ann. Thank you, Tom. Great information shared today. We appreciate the time you put in preparing for this and preparing the slides and presenting with us. So thank you very much. As we wrap up, I want to remind everyone, you can find the recording of this will be on our website, on the Small Business Bootcamp website. Lisa posted that link in the chat. So you can go to the chat, you can find that same place where you registered for this session. Additionally, we have 2 great sessions planned for next week, so please register for those and join us on a Tuesday morning at 9 a.m. Until then, please have a safe and enjoyable weekend with some of the moisture we're supposed to get in Arizona. So be safe, and we look forward to seeing you next week. Thanks, and have a great day.